Stop what you're doing right now, this second. Tell your dog you will walk him later. I do not care if you're in the shower. Get out and grab a towel. This is more important than whatever you think you're doing right now. Exit out of the dating app where you are swiping right on people. She will never match you back. Are we clear? Good. Oh, and one more thing. If you own silver, physical silver, ETF shares, futures contracts, anything, do not look at your brokerage account until after you finish this. Because if you look right now, you're either going to panic or you're going to celebrate. And I need you to do neither until you understand what is actually happening. Ladies and gentlemen, Asian man here. It is January 15th, 2026. And I'm about to tell you something that just 24 hours ago would have sounded completely impossible. Not just improbable, but flat out impossible. Yesterday, on January 14th, the silver market did something I have never seen in my entire life. Something that shatters every rule of modern finance. Something that mathematically, irrefutably proves that the paper silver market, the one dominated from New York, is dead, finished, kaput. The Shanghai Futures Exchange closed silver at the equivalent of $125 US dollars per ounce. Meanwhile, the COMEX spot price in New York remains stubbornly pinned below 90 after briefly touching an all-time nominal high of 93.50 earlier in the session before being absolutely obliterated in the thin, illiquid overnight hours. The spread, the gap between East and West for the exact same metal, the exact same commodity, the exact same element from the periodic table, is now over 35. $35 on the very same ounce of silver. In a functioning, rational market, this is not just unlikely. It is impossible. In a functioning market, professional arbitrage traders would buy silver in New York at $90, ship it across the Pacific, sell it in Shanghai at $125, and pocket $35 minus minimal transport and insurance costs. The gap would close in hours, perhaps minutes. Billions of dollars in arbitrage capital would flood in until the prices converged. But it is not closing. It is widening by the hour. And that can only mean one thing. There is no longer enough physical silver in the Western vault system to execute that arbitrage at any meaningful scale. The COMEX registered vaults are being drained to historic lows. The London vaults have already been hollowed out over the past 3 years. The banks that have maintained massive naked short positions for decades are now completely, permanently, irreversibly trapped. Let me take you back step by step so you can feel the velocity of this move. On Monday, January 13th, the CME Group, the operator of the COMEX, rolled out 2 emergency measures that screamed absolute desperation. First, they completely overhauled the margin methodology for precious metals futures, shifting to a pure percentage of notional system. Silver margins effectively spiked to 10-12% of contract value, a huge jump from the previous fixed dollar structure. Second, they have been aggressively hiking outright maintenance margins almost weekly throughout late 2025 and early 2026 as volatility went completely parabolic. Why the sudden panic? Because silver had already rocketed more than 32% higher in just the first 14 days of 2026. Retail buyers, macro hedge funds, commodity trading advisors, even whispers of sovereign-related entities were piling into long positions at a frantic pace. Open interest hit all-time record levels. The concentrated short position held by the big U.S. bullion banks, the same players who have controlled this market for 40 years, was bleeding hundreds of millions, sometimes billions. Every single day the price climbed higher. The CME's playbook is old, worn, and entirely predictable. Dramatically raise the cost of holding long positions, force margin calls on weaker speculators, trigger a cascade of forced liquidations, drive the price lower, and allow the banks to cover their massive shorts at artificially depressed levels. We have seen this exact script play out repeatedly. In 2011, when silver nearly hit $50, in 2020, during the COVID volatility, in 2021, during the Wall Street silver squeeze attempt, in 2023 and 2024, when retail kept pushing. Every single time silver threatened to escape the manipulated trading range, the CME pulled the margin lever. But this time, it didn't work. In fact, it backfired in the most spectacular historic fashion imaginable. I told you on January 13th that it would not work. I told you the fundamentals were overwhelmingly strong this cycle. I told you the physical shortage had moved from theoretical to acute and undeniable. I told you Shanghai was already trading at a massive, unclosable premium. I told you to hold firm, to stay calm, to absolutely refuse to sell into their engineered fear campaign. And what happened? Instead of crashing, silver detonated higher. Retail and institutional buyers across Asia interpreted the margin hikes as the ultimate signal of Western desperation. Chinese buyers flooded the Shanghai Futures Exchange with buy orders. Indian importers accumulated enormous tonnage quietly through back channels. Physical premiums on standard kilobars in Singapore, Hong Kong, Dubai, Mumbai, and even Zurich hit levels never seen before. some dealers quoting $25 to $30 over the outdated London fix for immediate delivery. By the close on January 14th, the Shanghai premium was already pushing $20. Commentators called it unprecedented and historic. Today, January 15th, that premium has exploded past $35 and continues to widen in real time as Asian trading sessions resume with renewed fury. This is not a temporary glitch. This is not a short-term dislocation that will correct itself. This is the final irreversible collapse of the 40-year paper pricing regime that has deliberately kept silver suppressed and artificially cheap. Now, let us dive much, much deeper, because you need to fully grasp why this is happening, why it is permanent, and why there is literally no way back for the old system. Start with demand. The unstoppable, structural demand that no amount of paper manipulation can overcome anymore. Global industrial silver consumption shattered every previous record in 2025 and is on track for another 15-18% increase in 2026. Solar photovoltaic manufacturing alone now consumes over 500 million ounces annually, more than 60% of total global mine supply in many quarters. Every major growth industry needs ever-increasing quantities of silver. Electric vehicles, each EV uses 1 to 2 ounces in electronics and batteries, 5G and upcoming 6G telecommunications infrastructure, artificial intelligence data centers requiring massive server farms, advanced semiconductor chips, military guidance systems, medical imaging equipment, RFID tags, water purification systems, antibacterial coatings. The list is almost endless. And unlike gold, where 90% plus is recycled in jewelry, virtually none of the industrial silver is economically recoverable at scale. Once silver is embedded in a solar panel, a circuit board, or an EV battery pack, it is effectively lost forever. China is the dominant force here. Beijing controls over 70% of global solar panel production and is aggressively expanding capacity to meet both domestic green energy mandates and export demand. Chinese manufacturers and strategic reserves do not trust Western paper markets. They buy exclusively on the Shanghai Futures Exchange, take immediate physical delivery, and stockpile in bonded warehouses or state vaults. When Chinese buyers are willing to pay $120 while New York is artificially capped below $90, every single available physical ounce on the planet flows east. There is no negotiation, no hesitation. India plays a similarly crucial, but often underappreciated role. Indian silver imports reached all-time highs in 2025 as traditional cultural demand for wedding jewelry, religious artifacts, and gifts combined with rapidly growing industrial requirements in electronics and renewable energy. Indian refineries, fabricators, and jewelers are paying whatever premium is necessary to secure supply. The traditional Indian wedding season alone absorbs 50-80 million ounces annually, and with the rupee holding relatively stable against a weakening dollar, Indian buyers are outbidding Western interests with ease. Japan cannot be overlooked either. The world's third largest economy has been trapped in ultra-low or negative interest rates for decades. Japanese household savings are enormous, much of it parked in low-yielding yen-denominated assets. As the yen depreciated sharply throughout 2024 and 2025, Japanese institutions, pension funds, and retail investors began rotating aggressively into hard assets abroad. Major Japanese trading houses, Mitsubishi, Sumitomo, Mitsui, Marubeni, are among the largest and most sophisticated physical silver movers globally. When COMEX prices are manipulated lower while physical premiums explode across Asia, Japanese buyers simply route orders through Singapore physical hubs or directly to Shanghai. They are not bound to accept New York's fraudulent price discovery. Even in the United States and Europe, physical demand has been relentless. The retail silver squeeze movement that began on Reddit in 2021 evolved into a steady, multi-year accumulation campaign. The U.S. Mint has been sold out of Silver Eagles and Buffalo Rounds repeatedly throughout 2025 and into 2026. Major online dealers, APMEX, SD Bullion, JM Bullion, Money Metals, have been rationing 100-ounce bars and kilo bars for over 18 months. When American buyers see COMEX quoting $90, but physical delivery from dealers costs $110 to $120 effective after premiums, they still buy aggressively. They understand instinctively that the paper price has become increasingly detached from reality. Now turn to the supply side, the side that has been structurally impaired for 15 years and is now reaching crisis levels. Global silver mine production has been essentially flat since 2010, hovering around 850 million ounces annually. Most silver, over 70%, is produced as a byproduct of copper, lead, zinc, and gold mining. As those primary mines age, ore grades decline, and capital investment remains constrained by stringent ESG regulations permitting delays and skyrocketing development costs, silver output simply cannot grow meaningfully to meet surging demand. The major silver-producing countries face unique challenges. Mexico, the world's largest producer, has seen output stagnate due to labor strikes, community protests, and new taxes on mining profits. Peru, number 2, has been plagued by political instability, road blockades, and anti-mining sentiment in key regions. China itself, despite being a top producer, prioritizes domestic consumption and has restricted exports of refined metal. Australia and Bolivia round out the top 5, but both face rising energy costs and environmental hurdles. Primary silver mines, those where silver is the main product, account for only about 25–30% of global supply and have seen almost no major new discoveries or developments in over a decade. The pipeline of future projects is thin, with most new ounces years away from production, even if approved today. The multi-year deficit between mine supply plus scrap recycling and total demand, now consistently running 200–300 million ounces annually, has been filled by drawing down above-ground refined stocks, but those stocks are now critically depleted. COMEX registered vaults, metal eligible for delivery against futures, are below 70 million ounces, less than 6 weeks of global industrial demand. London Metal Exchange vaults, historically the other major Western hub, have seen massive outflows to Asia over the past 4 years, with remaining stocks heavily encumbered or committed. The dollar context provides the perfect accelerant. The US dollar index closed yesterday around 97.80 after touching fresh multi-year lows. Gold is the clearest leading indicator. Yesterday gold touched 4,150 per ounce, another all-time nominal high, before settling around $4,110. That is a 62% gain in less than 2 years. The gold to silver ratio, which historically averages 50–60.1 in normal markets and compresses to 30–40.1 or lower in major bull cycles, remains stubbornly above 53.1 today. This means silver is still dramatically undervalued relative to gold even after this explosive move. As gold reasserts its ancient monetary role, silver, the ultimate hybrid monetary industrial metal, is catching up with violent, unstoppable force. Geopolitically, this decoupling is profoundly significant. For decades, the Western financial system has used unlimited paper derivatives to maintain artificially low precious metals prices, which in turn helped sustain the dollar's exorbitant privilege and masked true inflation signals. Low gold and silver prices made dollar-denominated debt appear more sustainable than it actually was, but that era is ending rapidly. BRICS nations, Brazil, Russia, India, China, South Africa, plus new members Saudi Arabia, Iran, UAE, Egypt, Ethiopia, are actively constructing alternative payment systems, trade settlement mechanisms, and reserve assets outside Western control. China and Russia have been the largest central bank gold buyers for years. India has repatriated gold from London vaults. Several BRICS countries are accumulating physical silver as well, recognizing its dual monetary industrial role in a multipolar world. When Shanghai price permanently decouples higher from New York, it marks the beginning of genuine price discovery centered in Asia, a tectonic shift in global financial power. Let me provide deeper historical context so you understand how truly unprecedented this moment is. In 1980, during the last great precious metals bull market, Nelson Bunker Hunt and his brothers attempted to corner the silver market through massive physical purchases. Silver spiked from $6 to $50 in months, equivalent to over $800,000 today when properly adjusted for monetary base expansion. The COMEX responded by imposing liquidation-only rules, banning new long positions and hiking margins dramatically. The rally was crushed, the Hunts were bankrupted, and the banks regained control. In 2011, silver ran from $18 to nearly $50 in 4 months on genuine physical demand from Asia and retail buying. The CME raised margins 5 times in just 9 days, triggering a 35% crash in a week. The banks covered their shorts profitably once again. In 2021, the Wall Street silver community on Reddit attempted to expose the manipulation through coordinated buying of physical metal and PSLV shares. Silver spiked to $30 briefly, but coordinated bank selling, media dismissal, and another margin hike killed momentum. Each previous episode featured a real physical shortage, but it was never acute enough to permanently break the paper system. The banks could always source sufficient metal from central bank leases, above-ground investment stocks, or temporary mine output increases to defend their shorts. This time is fundamentally different. Central banks are no longer net lenders of gold or silver. They are net buyers at record levels, removing hundreds of tons from the system annually. Above-ground refined investment stocks have been depleted after years of deficit. Industrial demand is now structural, exponential, and non-discretionary. Asian buyers have superior capital, infrastructure, and motivation to absorb every ounce at any price. The major bullion banks, JP Morgan, which paid $920 million in fines for proven manipulation 2008-2020, HSBC, Citibank, Scotia Mocatta, still maintain massive net short positions totaling tens of thousands of contracts. Every $1 increase in silver inflicts hundreds of millions in mark-to-market losses. They cannot cover without bidding price higher. They cannot deliver physical without draining remaining vault inventory to zero. They cannot hedge with new shorts because open interest is already at extremes and new longs keep coming. They are trapped in a classic short squeeze with no exit and unlimited downside. The CME itself is quietly adapting to the new reality. Their recent launch of a 100-ounce micro silver futures contract is explicitly designed to capture the retail buying frenzy they can no longer suppress through margin hikes alone. They understand the old control mechanisms are failing permanently. So where does price go from here? Short term, extreme gut-wrenching volatility. The banks will continue their signature overnight raids, algorithm-driven smash-downs in thin Asian or pre-New York hours, and coordinated media narratives about speculative mania and overheated markets. We witnessed it last night. Silver touched 94 intraday and was walked down below 88, but each smash is met with stronger, more determined physical buying when Asian markets reopen. The intraday lows are getting higher. The Shanghai premium is widening relentlessly. Medium term, $200 to $300 by the end of 2026 or early 2027 is entirely plausible. Major bank forecasts from before this blowout were already projecting 70-90 averages for 2026. Those are now completely obsolete. When the gold dark silver ratio compresses to 30 to 35 to 1, its level in the late stages of previous bull markets, and gold reaches $6,000 to $7,000, silver at $200, $300 becomes conservative arithmetic. Long term, if we witness any form of global monetary reset, partial return to hard money principles, or widespread sovereign adoption of precious metals backing, silver could revisit extremes far beyond modern records. In 1980, adjusted properly for today's vastly larger monetary base, that $50 spike would equate to $1,200 to $1,500 per ounce. The structural supply deficits, industrial demand growth, and geopolitical drivers today are orders of magnitude more powerful than in 1980. What should you do right now? If you already own physical silver, coins, rounds, bars, junk silver bags, store it securely off-site if possible and do nothing impulsive. Do not sell into volatility. Do not attempt to day trade the manic swings. This is the multi-year payoff for patience while the mainstream mocked and dismissed you. If you own silver mining shares, hold your core positions with conviction. Senior producers like Pan American Silver, First Majestic, Hecla Mining, Fresnillo, Wheaton Precious Metals are generating free cash flow at unprecedented rates. Many are debt-free or rapidly paying down balances. Junior explorers and developers with quality deposits are just beginning to re-rate as investors recognize the scarcity value of future ounces. The operational leverage in mining to rising metal prices is enormous. Historically, 3 to 5x the metal move in bull markets. If you remain unexposed, begin accumulating methodically on significant pullbacks. But recognize we are deep into the acceleration phase. Do not chase parabolic moves with leverage. Wait patiently for the inevitable bank-orchestrated smashdowns when fear peaks, then buy aggressively. Most importantly, permanently shift your mindset. Stop viewing the COMEX or London Fix as the true price of silver. The real global price is now discovered daily in Shanghai, Singapore, Dubai, Mumbai, Hong Kong, and Zurich, where actual physical metal changes hands between real buyers and real sellers with real delivery. This is not financial advice. This is simply clear-eyed observation of a historic, once in multiple generations, market dislocation. The Western paper, silver pricing system, is finished. The banks that built fortunes manipulating it for decades are now facing existential, potentially terminal losses. The physical market has decisively, permanently won. Asia is not merely rising. It is seizing full control of the world's most critical industrial and monetary metal, one irreplaceable ounce at a time. And there's absolutely nothing the CME, the CFTC, the Federal Reserve, the U.S. Treasury, or the legacy bullion banks can do to stop or reverse it anymore. Stay calm, stay disciplined, stay stacked. The greatest upward revaluation in wealth transfer in precious metals history is unfolding in real time, and it has only just begun.